Mark Cernicky is a managing director of fixed income at Principal Global Investors, and he's a big fan of high yield. He's here to tell us why. Welcome, Mark.
Well, thank you. Thank you for having me.
All right, why should I like high yield now? Bonds had a lot of problems this summer when yields spike. People are talking about a bond bubble. Why not just take it all out of bonds and put it into stocks with the S&P over 1,700?
Well, default rates are going to remain low. They're going to remain low for quite some time. A lot of the new issuance been coming into market has been for refinancing. That's pushing that maturity wall further out, so it's very supportive. Companies are in very strong, from a balance sheet, very strong standpoint. Have a lot of cash on the balance sheet. They've also managed to delever, so you haven't seen leverage tick up. And even the M&A activity, which we expect to pick up, actually is generally supportive of high yield companies, especially as you find investment grade companies buying high yield companies. That tends to be a credit positive for them.
And you're a big fan of the triple C's, the dreaded triple hooks. Now, people are supposed to avoid these because they're problematic. They have problems, which is why they're rated triple C. But you find them cheap. Tell me why they're such a good value now.
They're a particularly good value because with default rates remaining low, and especially because a lot of people don't follow them, there are a lot of those hidden gems out there where you can buy particular credits out there that are improving from a credit fundamental standpoint. The other things triple C's give you that maybe the double B's don't is they don't have a lot of interest rate sensitivity. It's basically a pure credit story. So if you're someone who can do credit research and do that deep dive into a company, you can be very successful, and you can actually pick up those triple C's that actually should outperform even double B's in this market.
And when you're doing your deep dive, which sectors are you finding the best values?
The best sectors actually are going to be European telecom companies as well as European cable companies. And particularly these cable companies, as we found out, very stable cash flows. They tend to be non-cyclical. And there's actually a big growth rate, especially from the non-incumbents. So you're finding basically the third player in a cable market. You take someone like a Matterhorn or Orange, Switzerland, who's basically the third player in the Swiss market. That market continues to grow. And for the Swiss people, what's really important is not so much price anymore. They're looking for quality of service, something that Orange can really deliver to them. So here you have a triple C company, which is really kind of a non-cyclical company.
Well, they need better service over there with the Alps, right? It's hard to get the signal. And then what about supply? You're seeing a lot of new paper hit the market?
Recently we haven't seen a lot of new paper hit the market. At the early part of the year we definitely did, but certainly the backup in rates has really caused a bit of a pause in the high yield market. However, even that supply that we have seen hit the market, about 70% of that has actually been really for refinancing. So you're not really creating net supply, and it's typically net supply that really is going to be driving the market.
Another thing that I think is interesting is that you recently recommended that investors can go a little bit further out on the curve, because all summer you kept hearing that investors should really bring it in, get as close as possible to the front end of the curve, but you're saying you can go out a little bit. Can you explain why?
Yield curves are very steep. And that's what sometimes a lot of investors forget. Everyone thinks that interest rates are rising, but what's tending to happen now is you're seeing the long end, the 10 and the 30-year move up, but the front end stays anchored. Steep yield curves really create especially very attractive, because by buying bonds, you can basically roll down the yield curve, you pick up a more attractive yield, plus you get the value when you actually see sort of the duration come in as well.
All right, thanks a lot, Mark.
Thank you for your time.
Thank you for watching The Street.